In March 2026, the U.S. Consumer Price Index was up 2.4% year over year. The Fed kept the federal funds target range at 3.5% to 3.75%. The January PCE price index was still running at 2.8%, and the average 30-year mortgage rate was 6.22%. That is not a zero-rate, cheap money economy, and it is not a panic economy either. It is a selective economy, which means saving money in 2026 is no longer just about cutting expenses. It is about building liquidity, protecting optionality, and deciding exactly which dollars need safety, which need yield, and which can take risk. So here is the first adjustment you need to make. Stop treating saving like a leftover behavior. In this environment, saving is an active allocation decision. The old habit was simple: spend, invest, and keep only a thin cash cushion because rates were low and idle cash felt wasteful. The new rule is different. Cash now has a job. It buys time, reduces forced errors, and gives you maneuverability when prices, borrowing costs, or income conditions shift. That is why the saving conversation in 2026 has to begin with structure, not motivation. You need to understand the operating mechanism first. Markets are constantly repricing future cash flows through interest rates, liquidity, volatility, and positioning. When policy rates are positive and capital is no longer free, every financial choice becomes more selective. Housing costs behave differently. Refinancing behaves differently. Equity valuations behave differently. And the penalty for poor timing becomes more severe. That is the market machine. The biological equivalent is stress response. When the environment gets tighter, healthy systems adapt and weak systems break. Your personal finances do the same thing. If your cash flow is stable, your reserves are real, your fixed costs are controlled, and your risk is sized correctly, then volatility becomes something you can absorb. If your reserves are thin and your obligations are heavy, the same volatility becomes an emergency. That is exactly why most people misunderstand saving in this economy. They still think saving is a moral act instead of a strategic one. They think of it as discipline, restraint, or delayed gratification. That is too shallow. In a 2026 economy, saving is about creating a balance sheet that can survive a high-cost world without needing perfect timing. If you do not see it that way, you will keep chasing visible yield while ignoring invisible fragility. You will optimize returns and underinvest in flexibility. And flexibility is what separates people who stay stable from people who are always one shock away from a reset. Look at the actual backdrop. Household debt reached $18.8 trillion in the fourth quarter of 2025, and 4.8% of outstanding debt was in some stage of delinquency. At the same time, the personal saving rate in January 2026 was 4.5%, which is better than late 2025, but still not a signal that households are swimming in excess margin. That combination matters. It tells you the environment is not collapsing, but it is not forgiving either. Saving money now is not about assuming disaster. It is about respecting how expensive instability has become. So the first new rule is this: your emergency reserve is no longer dead weight. It is part of your return strategy. You should think of cash in layers. The first layer is operating cash, which covers the ordinary month. The second layer is defensive liquidity, which covers the bad month, the job delay, the surprise expense, the market sell-off that arrives at the wrong time. The third layer is opportunity cash, which exists so you can buy quality assets or reduce pressure when conditions improve. If you earn stable W-2 income, that reserve can be leaner than someone with commissions, cyclical income, or business ownership, but it still needs to be meaningful. In 2026, cash is not just a parking place. It is a decision filter. Here is how you apply that. If your income is stable and your short-term obligations are predictable, you build a reserve that protects at least your essential expenses, not your aspirational lifestyle. If your income is variable, you increase that target. If rates remain elevated, you do not let the existence of yield on cash fool you into holding every dollar in safety forever. You keep enough to protect your structure, not so much that long-term capital never gets deployed. If the market drops and your job is stable, you react with calm because your reserve was built for exactly that moment. If the market rallies and headlines become euphoric, you do not empty your cash layer just because optimism feels expensive to miss. That is how adults save in a selective economy. The second new rule is that high-rate debt has to be treated as negative compounding, not background noise. This is where a lot of people lose the plot. They think saving money means keeping cash while investing aggressively, even when expensive debt is working against them every month. No. In a higher rate environment, debt repayment is often one of the cleanest, risk-adjusted uses of capital available to you. You do not get financially stronger by pretending the liability side of your balance sheet is separate from the asset side. If you are paying high interest, that is capital already committed before your future self even gets a vote. So if your market moves look smart, but your debt structure is bad, you are not winning. You are delaying a correction. If your credit costs are high, you prioritize eliminating the most expensive obligations first, while still preserving enough liquidity that debt repayment itself does not make you fragile. That balance matters. If you use every spare dollar to attack debt and leave yourself with no cash buffer, one unexpected expense can push you right back into the same trap. Saving in 2026 means sequencing properly. Safety first, then balance sheet repair, then scaled investing. The third new rule is to separate savings by time horizon with almost mechanical precision. This is not optional. The reason people keep sabotaging themselves is that they mix short-term money, medium-term money, and long-term money into one emotional pile. Then they respond to all of it with the same feeling. That is a mistake. Money needed within 12 months should not be exposed to major drawdown risk. Money for a 3-year plan should be treated differently from money for a 15-year compounding plan. Long-term money should not be judged by next quarter's chart. If you fail to separate these categories, then every market move becomes more emotionally loaded than it needs to be. This matters even more when rates and valuations both matter. If rates stay firm, the discount rate stays relevant, and long-duration assets remain sensitive. If inflation cools but stays uneven, cash may preserve optionality better than people expect while still losing ground in certain categories, like housing, education, or insurance. That means your time horizon is not just an investing concept, it is a saving concept. If you need the money soon, protect principal and access. If you need it later, allow measured volatility and keep contributing. If you are uncertain, do not force certainty by taking the wrong kind of risk. The fourth new rule is that your savings rate must rise faster than your lifestyle in a year when people still want to act like the old cycle has returned. This is where most households leak away progress. Disposable personal income rose in January 2026, and consumer spending also increased. That is normal behavior, but it is not automatically smart behavior. If every income improvement gets absorbed by subscriptions, travel, dining, rent upgrades, car upgrades, or convenience spending, then your financial structure never hardens. You just become more expensive to maintain. So when income rises, you do not ask how much more life you can buy. You ask how much more margin you can lock in before your habits adapt. If your paycheck rises by 10%, a meaningful portion of that increase should go directly into reserves, debt reduction, or long-term investments before your spending pattern notices it. You automate the move. You do not negotiate it each month. That is one of the new rules because discretionary saving is too weak for a 2026 economy. You need automatic structural saving. The fifth new rule is that investing and saving now have to cooperate, not compete. A lot of people still behave like saving and investing are enemies. They think money is either working or sitting. That is childish. In a world where the Fed is still above 3.5%, inflation is cooler but not dead, and mortgage rates are still above 6%, your capital needs different jobs. Some money needs to defend your life. Some money needs to earn modest yield without drama. Some money needs to compound in productive assets over years. The mistake is trying to make every dollar do the same thing. So if the market moves up hard, you do not assume all saved cash should suddenly become risk capital. You ask what that cash was for. If it was emergency liquidity, it stays where it is. If it was medium-term money, you reassess based on timing and need. If it was long-term capital, then a scheduled buying plan still makes sense, but you respect valuation, position size, and your own risk budget. If the market falls sharply, you do not instantly call that a buying opportunity, unless your reserve is intact and the capital was meant for long-term deployment. Lower price is not enough. The source, purpose, and time frame of the money all have to match. This is where most people stop, but this is the advanced level. Once you understand reserve layers, debt sequencing, time horizon separation, and savings rate protection, you have to start reading second-order effects. A rate cut or rate hold does not just affect cash yields. It changes mortgage affordability, refinance math, credit spreads, startup funding, corporate financing, equity multiples, hiring appetite, and consumer behavior. A market rally does not just mean confidence. It can also mean crowded positioning. A falling asset does not just mean discount. It can mean liquidity stress. If you save money without understanding those second-order effects, you may be behaving responsibly while allocating carelessly. Take housing. Mortgage rates averaging 6.22% still mean monthly housing decisions carry more weight than they did in the cheap money era. That means saving money cannot just mean clipping small expenses while locking in a housing cost that dominates your cash flow. It also means a person who stays flexible on housing may be making a better wealth decision than a person who appears more established but is structurally pinned down. That is a second-order insight. Your largest expense shapes your ability to save, invest, survive volatility, and act when opportunity appears. You also need to understand correlation breakdown and liquidity traps. In easy markets, people believe every asset bucket is diversifying them. In stressed markets, assets can move together because participants are selling what they can, not what they want to. So your true protection is not a hopeful spreadsheet. It is liquidity, size, and time alignment. And then there is bankruptcy math. A big drawdown requires a much bigger recovery. The same logic applies to your household system. 1 year of weak saving, heavy borrowing, and forced selling can require several years of good behavior to fully repair. That is why the new rules are strict. They are designed to reduce recovery time, not just increase comfort. Behaviorally, this is where people fail in predictable ways. They chase trends because recent gains make cash feel stupid. They get overconfident because a rally disguises poor process. They ignore timeframes because every asset feels like an opportunity in the same moment. They oversize positions because conviction feels smarter than caution. And then a regime shift exposes all of it. So your advantage in 2026 comes from building rules that keep working, even when sentiment changes faster than fundamentals. Now let's turn this into a working playbook. You begin each month by deciding where every saved dollar goes before you spend it. One portion goes to operating liquidity. One goes to reserve building until the target is full. One goes to high-cost debt if that problem exists. One goes to long-term investing according to a preset schedule. If your income is variable, you create a base rule and an overflow rule. The base rule covers your minimum savings behavior even in a weak month. The overflow rule directs excess income automatically into the highest priority destination, usually reserves or debt first, then investing. You do not improvise this in real time. If the market moves up sharply, you react by checking drift, not by increasing excitement. If equities have run and now dominate your allocation, you rebalance, or at least stop feeding the most extended area with oversized new money. If the market moves down sharply and your reserve is intact, you continue scheduled contributions and review whether lower prices improve long-term expected returns. If your income weakens, you do not reach for speculative returns to compensate. You cut fragility first. If rates fall meaningfully and your debt or housing setup becomes cheaper to refinance or restructure, you evaluate that with the same seriousness you would evaluate a new investment. Liability management is part of saving. To practice this skill, you need a process. Track your savings rate, reserve coverage, fixed cost ratio, debt burden, and percentage of new income captured instead of spent. Journal major decisions. Write down why a dollar is being held in cash, used for debt reduction, or invested. Reverse test every meaningful move. Ask what would make this decision look foolish in 6 months. Ask what happens if your income drops, if markets correct, if rates stay high longer, or if a major expense arrives early. That exercise makes hidden fragility visible before it becomes expensive. To maintain the skill, build evaluation loops. Review your cash flow monthly. Review your allocation quarterly. Review lifestyle creep every 90 days. Measure what matters. Months of essential expenses covered, percentage of income committed before payday, debt service ratio, savings automation rate, and error frequency. When you make a mistake, do not just say you spent too much or invested too aggressively. Identify the process failure. Were you too vague about time horizon, too optimistic about liquidity, too influenced by headlines, or too passive about fixed costs? That is where the correction starts. Then combine these saving rules with other tools. Use valuation so you understand what you are paying for when you move long-term money into risk assets. Use macroeconomics so you understand the environment acting on your cash flow, debt costs, and returns. Use technical analysis to see how positioning and trend behavior may be distorting short-term price. Use risk management so no single idea can damage your financial structure. Valuation without macro can make you early. Macro without technicals can make you inactive. Technicals without risk management can make you reactive. Risk management without a plan can make you permanently cautious. Integration is what makes saving intelligent instead of merely conservative. And test your rules under pressure. Use a simulation month where income drops by 20% and see how your system responds. Run a stress test where markets fall 30% while a major expense hits. Practice paper allocation changes before moving real money. Use small, real decisions to observe your emotional bias. The point is not to guess the future. The point is to prove that your saving system can survive more than one future. So the new rules for saving money in a 2026 economy are clear. Treat cash as strategic optionality, not wasted effort. Sequence safety, debt repair, and investing correctly. Separate money by time horizon. Capture income increases before lifestyle absorbs them. Make saving and investing cooperate instead of compete. Read second-order effects, not just headlines, and build a system that works when rates, prices, and your own circumstances stop behaving politely. And here is the detail worth replaying, because it is easy to miss the first time. The biggest saving mistake in a selective economy is not that people save too little. It is that they assign the wrong job to the wrong dollar. Once you catch that, the whole logic changes. You stop asking, how much should I save? And start asking the more powerful question, what must this dollar protect? And what is it actually allowed to risk?